That's a quick trip to the poorhouse.
To learn how to drive the beater before you can drive the Lamborghini.
Now you're playing with the house's money.
Ah, geez, I tell you, I remember the days when I was stuck in between what's the best way to approach trading? What's the best setup I can use? What's the best this? What's the best that? Not recognizing that I need to be working on myself to make myself the best. But, it's an interesting question. If you've ever asked which setup is best, breakouts or pullbacks, well, you're not alone. But what if that's the wrong question? What if your discipline matters more than your trigger? So we're going to bust the myth of there's only one way to trade, and it's Mike's way or it's Dennis's way. So, hey, coming later on, we'll show you two different styles of trading, but that both result in great results. And so, if you're blending your strategies and trying to mix things up and come up with some Frankenstein kind of mixture for doing your trades, I think this will be a session for you. So, Mike, what about it? Are we going to really answer the question which is better today? Or are we going to be it's going to be better than better?
Well, hey, you know what, Dennis? I think that there's room for both out there in the market, right? It's almost like you could like a tuna fish sandwich and you could like chocolate cake, but if you take both of them and throw them into a blender, that's when it doesn't taste very good anymore. And I think that all too often, I think that's what tends to happen in trading, because there'll be times when let's say a breakout strategy is working pretty well, and then we go through a period of the market where breakouts start failing, and then people are like, well, let's toss that aside. Oh, hey, when price pulls back to the support area, that starts working. And then they try to come up with this Frankenstein monster of, well, I hear this part from Mike, and I hear this part from Dennis, and maybe I hear this other part from somebody else. And then they try to blend everything together, and they don't quite mesh as well as you might think.
Okay. So is it kind of like the situation where I remember my dad would always say, he would say, don't become a jack of all trades and master of none.
Yeah, that's a good one.
Yeah. I mean, is that kind of what we're talking about here? Is that people it seems like they're attracted by a lot of different things. One, the shiny object syndrome. Okay. What's the hottest thing for right now? And we get that a lot, especially with the level of social media discussions and contacts and people, ranting and raving, and the Lamborghini guys over on Instagram, all the great traders, wise and disciplined traders over on X or LinkedIn. And so it can be confusing, right?
Yeah, it could be very confusing. Another thing that adds to the little confusion too comes from the definition standpoint. One person's definition of, say, a quote unquote breakout might be different than the next person too. So when when you and I get into it, I want to I'd like for us to take a little bit of time to just get crystal clear on the definitions that we're using, so that way, when somebody else is listening, they can see, oh, okay, I understand what these guys are talking about.
Okay, no, I agree with that wholeheartedly. And so, one of the things that Mark Douglas mentions in one of his books, he talks about pick one setup and master it, make it yours, and don't move on until you can trade it flawlessly. And you're probably too young to remember when they used to have mercury in thermometers.
No, I appreciate the compliment, but no, I am not too young to remember that. I remember that vividly.
Okay, well, don't try this at home, right? But back in the day, we would get a hold of these little mercury thermometers. Maybe you've done this too. And we break them open, and the mercury would, like, you could pour it in your hand, and, like, probably gonna all die from hand cancer or something like that. But when you would try to touch it with your finger, you know how the mercury would just move away from your finger. However, you could put mercury onto. We used to love to put mercury onto quarters and make them look all shiny and new and all that type of stuff. But it was always amazing to see how as you put your finger down towards the drop of mercury, it would run away from you. So it's like, similar thing with trading is that we try to, oftentimes, because we don't master anything, we try to, put our finger down and, we're going to make this work this week. But by the time we get our finger on it, it's moved and it's moved on.
Right.
And so, what are some of your early trading struggles? Because we are going to get into digging into that, and before I do that, I want to ask a question. And folks, if you're out there listening, I recognize you may be listening on your mobile phone, you may be listening on but if you're where you could type in something, which are you? Are you a breakout trader? Are you a pullback trader, or an other trader? So if you would type in a B for breakout, P for pullback, or O for other. Let us know which kind of trader you are, because we did do a poll on this, Mike, and the poll results we'll share in a little bit are really remarkable. So anyway, what about, what were some of your early trading struggles when it came to strategy hopping or trying to figure out, are you a breakout or a pullback trader?
Sure. So I remember starting out with Can Slim and William O'Neill style trading, and the patterns that we come to know and love, right? Your cup with handle and your flat base. Generally, when price is moving sideways and then is breaking out into new high territory, that's the buy point from the pattern. And I remember going for some trades where I would need to try it, not just once, but maybe 2, 3, even 4 times in order for this thing to start moving up, and away. And that started to become very frustrating, because you take 1 loss, you take 2 losses, you take 3 losses, and then all of a sudden, you really need that 4th one to be able to go into full profit, just in order to break even overall. In the Can Slim strategy, where basically the straight out of How to Make Money in Stocks, you would take profits at 20 to 25%, your losses at about 7 to 8%. So 3 losses in a row, losing 21%, you really do need that last one to hit that ultimate profit target. And so, that's started to become a point where I was questioning, is it me? Is it the system? Well, what's going on here? Because if I keep on operating like this, we're going to have some problems.
Yeah, without a doubt. And so, and I can remember the concept of, I had read the William O'Neill's book about how to make money trading stocks, and I love the process. I love how he designed to find strong stocks and all that kind of stuff. But I always found it frustrating with the types of breakouts that they use there in with the Can Slim process. Frustrating in that it always seemed like, well, you get the breakout, but then you get the pullback. You get a drop back in, and I'm sorry, but that just increased my pucker factor so badly that I went,
pucker factor?
My pucker factor. Yeah, it's that's an aviation term that had to do with when you did a dive too deep, or you did a turn too strongly, or you just missed running into your wingman. Your pucker factor goes woo, and You may also get that. No, I won't tell you when you're driving sometime. But anyway, what I was going to say about that is that, okay, I found it very frustrating. And part of my frustration was what it turns out to be. Part of my frustration was due to lack of understanding and lack of knowledge. In that what I've discovered since, because I went on and I dove deep into other, into getting, with the Market Technician Association, MTA. They have a designation called the Charter Market Technician thing, where you take a test and you become a CMT and this type of thing. And I did all the work to do that. I was almost like a master's level in technical analysis, and I learned a lot about technical analysis. And in that education, as I applied that, I saw, okay, here's the overlap with the CAN/SLIM process, technical process. However, it's slightly different than some of the, what the classic technical analysis process was. But through doing that, I was able to understand that, well, when you get a breakout, 70+% of the time, you get a pullback. And so that kind of shaped my thought pattern for how to, what I look for when I'm trading, that kind of stuff. But I was, I can remember that, I would always be, the other thing that held me back is that I would be inconsistent in my application of the rules that I had at that particular time. And that inconsistency led to painful losses. And it was when I was able to clarify and simplify it down to just some basic rules. Like I had 4 rules to enter and I had 5 rules to exit. That was it. And I don't know if you like when you were doing your pure CAN/SLIM process, there's like 15 or 20 rules to enter and sometimes just as many rules to exit. To me, that seemed like a lot of variables. So how did you deal with the variables? And we'll get into it here shortly. Do you call yourself a classic breakout trader?
Well, no, I don't think that I would consider myself a classic breakout trader. And when we get into it too, when we pull up a couple of charts, I want to see what your definition of breakout is, and I want to see like how well my definition of breakout lines up to yours.
Okay.
We're going back to canceling with all those rules, how I handled it, not well. Not well at all. I actually ended up with about maybe close to 100 different buy rules and maybe about 80 or so different sell rules altogether from going through the entire book. I went through everything, highlighted, and started to pull out rules and say like, all right, this is what I'm going to follow when I'm buying. This is what I'm going to follow when I'm selling. And then I came up with a couple of rules that there were maybe not too many, maybe like an extra 5 or 6 for myself, plus a couple that I picked up from the IBD meetup. And I remember sitting there in a trade, and I saw price starting to pull back in, and it's like, all right, let me consult my sell rules here. And I was able to check off maybe about 5 or 6. Wonderful, I should be selling. And then I took a look at the buy rules, and it's like, there's some buy rules in here that I should be buying on a soft pullback to the 50-day moving average, let's say.
Sure.
And so that led to, it didn't lead to the clarity that I was hoping that having all those rules led to. And so it was back to the drawing board as far as just having a list of rules went.
Okay.
And so, what was your experience like?
it was like, okay, it was overwhelming to for lack of a better term, because at that time, and this isn't a critique of Investor Business Daily, it at all whatsoever, because
Mhm.
as far as I'm concerned, they are the best entity out there at finding your strongest growth stocks,
Oh, sure.
and the process, uh, and also for someone who has the time and the wherewithal to apply all of the
Mhm.
rules they have, can
Right.
do really, really, really well. I was working full time, 10 to 12 hours a day, 6 days a week, building wireless telephone networks across the U.S.
Mhm.
And I didn't have time. And back then, it wasn't the IBD 50 list that came out every week, but it was the IBD 100. And so
Right, right.
that,
I remember that too.
yeah. And so it was so much. And then there was all the other, you know, watch lists that were really great stocks and all that kind of stuff. And so I had to learn how to manage the magnitude of the information that was available. And much like how you boil, you basically um, let cream come to the surface when with fresh milk straight from the cow. You have to let the milk settle a little bit, and the cream will start to rise to the top. And you skim the cream off, leaving you with milk, and then the cream you go use it for something else. And so that's what I was looking for. How do I skim the cream off the top, so that at the end of every week I'm down to, you know, a list of maybe 50 stocks that I want to be interested in, but then
Mhm.
I quickly bring that down to five stocks.
Right.
And I think one of the things that helped with that was basically the technical analysis that I do. But uh, secondly, the other thing that helped with it is the advent of the leverage ETFs. Oh my
Mm.
gosh! If I were starting trading right now,
Okay.
and my mentor who I would gladly pay to help me out, and he or she said, focus solely on trading TQQQQ. You don't need to trade anything else. Um, I would have been so far ahead, because what I've discovered about trading TQQ is that it's a solution to time demands. It's a solution to being wondering whether or not I'm going to find an entity that I will trade that will be profitable, simply because
Mhm.
its track record is so great. And
Mhm.
so, and I wasn't meaning to get off course there, but what I was said that to say this is that by learning to narrow my focus down, eliminate things like earnings, eliminate things like, as much news as possible. That way I could
Right.
focus just on the technicals, whether I was looking to trade pullbacks, breakouts, or a hybrid of both, because it
Yeah,
kind of remind, yeah,
yeah, no, I was
but
just gonna say it boils down to a simple math equation, right? Where if we have like just simple algebra, the more variables that you add to the equation, the more complex the equation becomes. So if we start to make our research, where we're getting the research from, a constant, and the types of setups that we're going to take a constant, then the only thing that we need to worry about is just, okay, does this fit the chart pattern, yes or no? And then we're doing our analysis on that part. Makes the whole equation a lot easier.
yeah. So have you ever run into somebody who was just so frozen in on the magnitude of everything they thought they needed to be watching, that they froze up and were basically almost driving themselves insane, uh, because they couldn't make a decision about what to trade. And
Have I?
no, have you ever run into somebody like that?
Oh, sure. I mean, I look at that person in the mirror every morning.
Okay.
Um,
Not
a-
your
and and thankfully, there was a light at the end of the tunnel that after many years, and I've been able to help other people with that too. It tends to come in the form a little bit different for everybody, but well, when we start to get to that point where there's this overwhelm, uh, well, what I've seen happen often enough is, well, we tend to table what the thing that's going to give us growth and go back to something that's a little bit easier, or maybe even a distraction of
yeah,
some kind.
yeah.
Sometimes that could take the form of journaling. I was speaking with somebody uh, earlier this week, and they were trying to figure out, well, should I be using one of three different journaling platforms, right? Like, which one is better, and how am I going to analyze my data, and dive into this? And this is a pretty smart guy, a guy that I've been working with for a little while. What was better for this person was to come to the realization that it's not more data that's going to get you the results that you want. It's putting in the reps. So just pick one of these platforms
Right.
and just go with it. It doesn't really matter that much. Focus on putting in the reps. Focus on to your point, right? Like defining what's the 1, 2, or 3 setups that you're going to take. Go and master those setups. Find the historical trades that have matched those, and create your model book. Those are the kinds of things that train our mind to be able to pick up on those things, understand how they work, and when they don't, and be
Yeah.
able to capitalize on it a lot better.
Yeah. What reminds me, one of the meetup groups that we used to do back with the old Invest Tools days. Those of you who might remember Invest Tools, uh, is this young lady, lovely young lady. We were sitting together on the, sitting next to each other on the couch, and she says, "Dennis, I need your help." And she goes, "Dennis, I need your help." She goes, I can't I can't pull the trigger to make a trade. And I said, "Well, Susan, what seems to be the problem?" She goes, "Well, I'm watching these 50 stocks, and while I'm watching these over here, the ones over here move, and I missed the move, and I'm just so frustrated." Now, a little background on Susan is that she was a psychologist.
Mm,
Okay, and she's sitting there all wrapped up with this FOMO stuff. And so I said, "Okay, Susan, let's build you something that is going to help you out." And so I said, "Well, how many triggers are you looking for?" "Well, I'm watching all these triggers, these 7
mm,
triggers." I said, "Well, let's reduce that down to 2." "Oh, I don't know if I can do that." And so I go, "Okay, try. Let's try it for a week, try it for 2 weeks, try it for a month." But then I got into basically the territory that was just restricted and nobody could go to. I said, "And the next thing we need to do is let's take your 50 stocks and let's break it down to 10 stocks you'll watch religiously, and that way you reduce the probability that you're going to miss the trade." And she goes, "I cannot do that whatsoever." And I'm going,
mm.
"Really? Why not?" She goes, "I can't do that because if I only watch 10 stocks, I'll miss what those other 40 stocks are doing." And I said, "Susan, you're missing them now. Why not try something different?" So, if you're out there and have going through that kind of machination in your brain, and the audience is listening, you're not alone. Here's a professional, a mental health professional, just melting down and just kind of going ballistic because she wasn't able to make a habit-changing decision that would help her in the long run. So that's one of the things that, she had, like we called it earlier, Frankenstein strategy that was cobbled together of all these different things. And her belief system was that she really believed she needed it all.
Yeah, and that's not uncommon. No, well, when we end up chasing too many things, well, we end up catching nothing.
Oh, exactly. Yeah. And
Uh,
so, well, yeah, go
so
ahead,
much
Mike.
better off just chasing, going after one trade, right? Well, when you go after one trade, you're far more likely to catch that one trade than if you end up trying to chase two, three, five, or in her case, 50.
Yeah, exactly. And because I mean, I generate a list of 50 stocks every week, but I quickly hone that down because I know I can't manage 50. The
Yeah,
other
no.
thing is in William O'Neill's book, he talks about it. He says don't invest in any more than 10.
Right. And I remember at one point he mentions in that book that he was long 200% in just Google and Apple.
Yes,
Now,
yeah,
he didn't just buy them all the shares all at once. He built those positions over time, but 200% long Google and Apple.
okay. And so, yeah, I mean, and that's the other thing is that we think we need this, this diversification. And some people call it diversification rather than diversification. But we think
Yeah.
we need that because it offers protection. But that's one of the other reasons why I like trading the leverage ETFs like the TQQ representing the NASDAQ
Mm.
is because it's already based on what 200? No, how many stocks are in the 100 stocks are in the Nasdaq? Yeah, Nasdaq 100.
Mhm.
It's already based on 100 stocks, and so it's built in uh, with diversification. So okay, so
Right.
hey, let's dig into what the heck's the difference. What's your idea of a breakout trade, and what's a pullback trade? How do do you have a setup then a trigger? How do you make that work? And do we need to be looking at charts?
Yeah, I think we should be looking at charts. So why don't I pull up uh, one of the stocks that I took as, and I'm seeing this as a breakout trade.
Okay.
But you tell me if this fits your definition of a breakout, or if you would be looking at this as, oh well, actually, Mike, this is a pullback. So
Okay.
here,
Just tell me what it is. Can you share?
HRTG.
HRTG.
Yeah.
Okay. I'll be not looking at the camera because I'm looking at my chart over my. So
All right. And
when,
I have
where, and
I clicked to share my screen. So if you wanna be in the driver's seat, if you want me to be in the driver's seat, my screen is there.
yeah, go
Whatever's
ahead.
easier.
I guess we got to do. Yeah, Cliff. Go ahead. I'll stop sharing my screen. You go ahead and share yours.
Okay, you just need to add it to.
I
Uh,
did. There we
oh,
go.
there it goes.
Okay.
Okay, great. So this is a trade that I'm in right now. The ticker is HRTG, Heritage Insurance Holdings.
Okay.
I saw this set up as a high type flag because over the last 8 weeks, it ran more than 100% from the bottom of the pole, which started back here in March, to the top of the pole, which ended in the middle of May, ran 170% about. So fits that definition very well. Then price pulled back to that purple line. For me, that purple line is the 21-day exponential moving average. And I saw it
Sure.
pulling back. And then when it bounced off of it and followed through, I'm actually looking at that bounce right there as a breakout from where I bought, or I'm buying that bounce. So
Yeah.
because I'm buying strength, I'm looking at that as, okay, it broke above this day's high, the last day's high, it followed through over here. And I'm looking at that as, I'm calling it a pullback for so I'm not buying weakness, I'm buying strength.
Sure. I got it.
Would you classify that as a pullback or a breakout, or what yeah, how would you describe what I did here?
I would almost categorize that as kind of a hybrid, because it's like I see that you're doing that is okay. The pullback is your setup. Your
In this case,
trigger, your trigger would be, in this case, moving back above, breaking out above the 21-day moving average. Okay,
okay.
and now others might, if you go over to the 30th.
The 30th?
Yeah, the 30th, which is right
So right
there.
here.
Okay. Now, some people also may categorize that as being a breakout because you're breaking the trend line, right?
Right. And I think that this might be where some people start to think of, well, breakouts don't work, but some people might look at the breakout to the all-time high as a breakout.
Exactly. Yeah. And oftentimes I think some of the setup that like Mark Minervini uses, and they also use with IBD type setups and all kind of stuff, you're looking at the breakout of that all-time high, right?
Right.
And those are the ones that tend to get a 65 to 75% pullback rate, where it'll pull back to the breakout, toward, not to all the way to the breakout level, but towards the breakout level. That's another thing that traders need to remember out there, is that if you drew a line across the all-time high there, up there, whatever the price of that is, yeah, wherever that is, right?
Okay.
Let's make that your all-time high.
I'll make that a little bit bigger, thicker for people.
So anyway, if that's your all-time high, and until you break out above that, is that it's totally reasonable for price action to pull back towards that breakout area. At the same time, though, if you will look what happens back when you did your back when you have your initial pullback back to the 21-day moving average, didn't you get a fake out breakout?
Yeah. That's exactly what happened. They broke out here, then pulled back. It came within my initial stop was at $22.40. It came within 23 cents of stopping me out that day, and then it reversed and closed just above where I had bought it.
Yeah. And when you get those kind of trades,
happens plenty too, where you need to trust your plan and
exactly. Yeah.
follow through.
And so, that's what I'm saying, is that, there's a couple of things, and their definitions, and one of them is, are you fading the pullback, or you said it earlier, or are you waiting for a momentum shift or a strength to show after the pullback? And it's two slightly different kind of, well, not slightly different. They're hugely different, because what a person who fades the pullback would do, they would define a little zone right there where your arrow shows a reversal off the 21 EMA. They would potentially define a small zone around that 21-day moving average. When I say a small, let's say, well, how much is your stock? $22, somewhere between 10 to 30 cents, a little, and so expecting it to pull down into that zone and then bounce. Now, if it doesn't bounce, of course, your stop is like 2% away. I mean, you just basically cut it off at the knees and get out with a really small loss. So that's would be fading the trade, fading it back into the moving average or the longer term support. And then down 3 days later, after you did your breakout fake out, right? Which is a solid breakout. Okay. The other part of the understanding there on, if you bought on the close above the, I guess, is that the 8-day moving average or is that the 10?
The green line, that's the 10.
Okay. So the close above the 10, was that your trigger to get in?
No, I initially got in on this day here. So what I was seeing, so it was seeing several confluences around that level that helped me to buy at 2360. The first was getting in above not just the Friday and Thursday high, but also starting to get above the 5 and the 10. I took a Fibonacci retracement and I saw that lined up with it as well.
Okay.
Then I dropped down to a 30-minute chart to see, well, how is this lining up down on the 30-minute time frame?
Sure.
And I noticed that this level here lined up with, well, what developed as a short-term support area back here. So it's like, okay, we're popping back above that level. So several things working all at the same time. Wonderful. 2360 looks like a good spot to get in. But what I liked even more about it was the support zone at 2240 lining up with that 21-day exponential moving average, as well as this price bar back here. Let me make this a little bit thicker for people. This back here, it all lined up very nicely.
Yeah. No, you're absolutely right. What is that, an hour chart or 30-minute chart?
A 30-minute.
Okay. Yeah. And that's a great way to use your intraday charts like that to define some of that. You can oftentimes pull out some hidden levels of support / resistance that only show up on the intraday charts. But I wouldn't go to like, if you're trading a swing trade that's going to last several days, I would say that you should go no lower than a 30-minute chart.
Yeah.
And so some people I remember this lady one time, she was watching the 1 minute and 5 minute charts. And I asked her, I said, how long are you, what's your projected time frame for this trade? Oh, it's a 2 or 3 week swing trade. I'm going, then why in the world are you watching, 5-minute charts? So that's just so noisy. It's not going to give you anything. So, but back to this, this is a beautiful trade. And again, one of the things that, that I do use is I use candlesticks, right? So can I show you my chart?
Sure. Yeah,
if I can find it. I know I have it here somewhere. Here we go.
Okay.
Let's look at this. Let's look at this same chart, but let's take a look at it from share screen. Is that the one I want? That is the one I want. Okay, allow. And digging into the same thing, Mike, that you were talking about, which I absolutely love. And again, and you can see my screen, yeah?
Yeah.
Okay. One of the things that's really interesting, folks, is that this is a really HRTG. When I would be analyzing this, I'd be looking at it and say, yeah. I would be going, I don't know if I'd be buying this or not, but simply because the volume's a little bit low for me, because I want to buy 500,000 in average trade. But besides that, let's just look at the technicals on it. And again, this is why I utilize the candlesticks. Now, here is the day that we pulled back and hit what I use is I'm using the 20-day moving average, not the 21, and I use the 8-day moving average. Those are EMAs. And so slightly different than what Mike uses, but they still do the same thing. And so when did you enter the trade, Mike?
I entered the trade on the 27th.
Here. The 27th here.
Yeah.
Okay, cool. So did you buy it right at the open, or did you wait for the close?
I bought it as soon as price crossed 23.60. So
okay, cool. You buy just popping up above the 10. Approximately. Popping up above the 10-day moving average.
Yeah.
So folks, what I would be looking at is I'm looking at a couple of things. One is we've got we had our nice run up, and volume increase and all that kind of stuff. Then I'm getting this really nice pullback, as you can see right here. Let's draw that across there. Let me shrink that down a little bit and do it again. There we go. Okay. One, as soon as I have that high right there, I've got enough. I know where this short-term downtrend is going. What else do I know? I know that a couple of things. One is that low actually corresponds with the midsection of this big green candle. What do I know about candlesticks? I know that the middle third of a big candle like that, either red or green, is a level of either real strong support or real strong resistance. We see the same thing over here. What did it pull up into? Midsection there. So I go click. Okay, great. Then, and I love this, is on this day here, which is the 23rd, which is a Friday. By the end of the day, I have what's close to being a bullish candlestick reversal pattern. Yeah. I have a bounce off of the 20, and then a piercing line, which is a cousin to a bullish engulfing, and then on Monday, which is the 27th here, I get that close above the 8. Now, for me, okay, if I didn't see this all over the weekend, I probably wouldn't have put an order in. I'd be looking for it to come back and retest against the 8, but it bounces back up on Monday and then stops. And let's say I found that right here. One of the things I will do is I would buy a breakout above the 8. The only thing that would be bothering me about that particular breakout above the 8 is this. That is not quite up to my downtrend line. So I'd be looking at it saying, that's a place where it could reverse. So I don't know if I would have bought it here on that breakout. However, if I was interested in buying this, past all everything else I wanted to buy it on, I would be looking to buy it off of the pullback into the 20-day moving average right here. And I could go off of whatever my price was there. And so my low there was, in that case, 22.61. So I'd put an order in to buy it somewhere between, let's say $23 and $22.61. And that would be a conditional order that I would put in that would act like a stop limit order, where it would only get filled if it was in that little range. So, and then from there, so I'm buying there, and then we were rewarded by it taking off here. If I would have missed this one there, another opportunity would be breaking above the 20-day again, this would be the breakout trade, and this is kind of my hybrid thing, is
Mm-hmm.
I could buy above the high of the low day
Okay.
as another opportunity. And that goes right back. If you've read some of Dr. Elder's, Alexander Elder, some of his work, he uses that as one of his major entry is he'll buy a move above the high of the low day.
Mm-hmm.
Again, and part of the reason why I like either way, if I would have bought there, let's just go. Yeah, you'd be carrying about a 5.5% stop loss,
Mm-hmm.
and so that works. And so that's again. So what's the similarities between what you and I do? Because we're both looking at similar stocks, right?
Yeah, well, a couple of the similarities. We're both using very similar moving averages. We're
Yeah.
both looking at very similar structure. Um, we're looking, we're similarly looking for that stocks being in at least in this example, stocks being in a strong stage 2 uptrend,
Yeah.
and then pulling back and tightening up. And I think that tightness is what helps us to better define the low risk, right? Because
Oh,
and by low risk, it's the difference between where we enter and where we'll take the loss. So it
yeah.
seems like, and correct me if I'm wrong, we both want the risk to be about this much, where you have maybe about, I don't know what it was on your side. On my side, the difference between the entry and the stop was about 5%. But I'm
Yeah.
looking for the trade to potentially go more than 20%. So
Oh,
in
yeah.
that case, I'm making 4 times my risk if the trade works out.
Yes. And then one of the things that I will look at, especially if I'm buying it right here off of the level of support uh, down here, is I would also throw this in here really quick. One of the other things that I really like to take a look at is Wilder's um, ATR, but I used a percentage
Okay.
of the ATR. Let me add that really quick in here. And at that particular point in time, my ATR was about 5.64. So isn't it kind of funny? That's percentage. Isn't it kind of funny that we both were, I won't say eyeballing it, but just where we took the trade. Well, we've been conditioned, I think, to say, okay, here's where my stop should be. Because if the swing low here would have been 10% away, where would you have put your stop? Because I know you don't usually go for a 10% stop.
Yeah, no, that's actually one of the filters that I use. And if I need to have a 10% stock on the trade, 99% of the time I'm passing on it.
Okay.
It would need to be a real special circumstance where the special stock, and by special, not just like a pet stock, but it have to meet all the fundamental and technical criteria, be the leader of its group, that sort of thing, but also the proper market conditions for it.
Yeah, right on.
Where we're just in that kind of momentum environment where it's like, okay, I'll size down a little bit so that way if it takes me out of 10%, I'm not losing as much. But it makes sense where if I'm risking 10% and I'm able to make 30% on the trade, then it still has that 3-to-1 reward to risk. But if
Okay.
it's something where, oh, I've got to risk 10% to make 15%, well, that to me, that doesn't make a whole lot of sense.
Yeah, yeah. And so, no, I agree with one of the other ways I do to protect myself from that kind of situation where I'm outside my 8%, my 5 to 8% range, is I'll just reduce my position size. If
Hmm.
if if, but it's got to be some really strong criteria for me to do that. Uh,
Right.
that's and it's one of the things that I've learned is I'll use this APTR down here, and right now
Hmm.
it'd be sitting at 5.6%.
Right.
and that's the percentage of the ATR. So
Okay.
what I'll do is I'll take that 5.6%, I'll multiply it times a factor. I'll multiply by 1.2. And then that's what I would apply as my max stop on this. And it
Mhm.
gives me a little bit more leeway. So 5.64 times 1.2 gives me a stop loss of 6.78% from
Mhm.
my buy point. And
Okay.
and that will oftentimes keep me in the trade, because a lot of people will go 1 ATR and put their stop loss there.
Mhm.
So this puts me just outside that range, and it
Yeah.
usually works out pretty darn well. So, hey, let's switch back to yours and let's take a look at a couple of. I'm going to add you back in.
Okay.
I think I'm going to add you back in. You may have to add you back in, or do I?
No, no, I'm back down there.
I see you, but I can't.
You just you
Do
can't.
I need
It's
to?
not letting you click on that.
Before, oh, I need to take my stop screen. Daggone it. There, now try yours.
All right. Yeah. You need to add it back. There we go. All
Okay.
right. So you wanted to look at the TQQQ, right?
Yeah, let's look at TQQQ, and then we'll finish it up with one of the small nuclear reactor companies. So go ahead and let's jump on
Exciting.
TQQQ, and we want to focus on around the date of 4/30, 30th of April.
30th of April, right here. All right. So what are you seeing there, Dennis?
Hold on a second. Let me get it up. And I'm going to blow yours up.
Yeah, interesting. Well, we're both trading this around the same time, and I didn't trade TQQQ. I just traded the regular QQQ.
Okay. And so right there. And so I had seen the breakout, and so basically I put an order to buy it down at somewhere around $52.
Okay.
Okay. And so that's where we wanted to get in. And we sure enough.
That's hilarious because I bought it right here. I bought QQQ right here. So
Yeah. Okay.
so I bought the breakout and you bought the pullback.
Yes.
That's awesome. And we didn't pre-plan that either.
No. And then
We're just
this
looking
one.
at the same stuff, and this shows you how two guys could be trading slightly different styles, but still trading the same stuff.
Well, exactly. And the thing about it is what's what's critical, and it's part of it's the mindset thing is,
Mm-hmm.
okay, if Mike's going to be trading the breakout, or if I trade a breakout, okay, in my mind, I have to be comfortable with the reality that I will probably get a little bit of a pullback. That's
Mm-hmm.
just normal. That is just normal price action that I need to be aware of.
Mm-hmm.
And so I don't get in a tizzy just because it starts to pull back. Because, one, I have to remember, I've got my stop loss in place, right?
Right.
So I have built in my protection. And if it does go against me, that's life. I mean, that's part of the life of a trader. But it is kind of interesting, Mike, is on the Qs, you got in on that little bit of a breakout. And let me get the date on that. I was
The
looking
25th.
at.
Yeah, it was on the 25th.
You got in here on the 25th, and then okay.
Yeah, on the
The
Qs, it looks
25th.
like this.
Yeah, exactly. And so what's interesting, that's on a Friday, and over that weekend, I prepared our list for my autopilot trading members of what we were, what I was going to be buying the following week. And
Mhm.
I was going to be buying TQQ, and I based it off of the expectation that I was going to get a pullback into the moving average lines. And then,
Mm.
sure enough, that's exactly what happened. Now, if it would have gone on up, would that have been okay? Sure. I mean, that's okay. That happens. Um,
Mm.
so either way, that's kind of cool. So that's it on TQQ. What about NNE?
NNE. This one I did not trade, but I'd love to hear how you went about trading this one.
Okay, I entered this on 5-5.
5-5. Okay, 5-5. So right here.
Yep, similar
Okay.
process. And then it basically, just mashed around a little bit, and then it broke out and ran like a big dog. Now, how would you show me where you would have bought with that on this one?
Oh, geez. Let's see. Well, let me reset this chart.
Okay.
I mean, it looks like it's tightening up right in here.
Okay.
So draw something like this, and then I would try to take a measurement. Well, if I was going to enter on a break above, say, this bar right here, what would I need
Right.
to risk in order to do that? So then I'll take this part and raise it. And then when I see, oh, I need to risk almost 10% to get in, I'm not even taking this, because
Okay.
I wouldn't want to risk that much. For a stock to just get to twice my risk. I'd rather take a trade where I only need to make 10% to make twice my risk, versus this one where I need to make 20% to make twice my risk. Obviously, the trade worked out very well, but yeah, it wouldn't have passed my screen.
Well, see, and that's where if you look there, the 5th of May was a Monday. And so that means that on that previous Friday, go back one ticker right there, we'd gone up and we'd hit off the 50-day moving average. And then, so I was sitting there going, okay, what can I take away from this chart? And what I could take away is I had a series of past support levels that, and if you will, from where I got in at 22 and some change, to my stop loss on that, the max stop loss was going to be basically dropping back down below the 200-day moving average, and
Okay,
that would have given me a stop of about 7, not quite. Darn it, can't get darn through this. There we go. Somewhere between 6.5% to 7%. That would be my stop. So then all of a sudden, okay, that then in turn, I knew that this was a big mover. And so actually on let's see, on the very next day, on the 6th, I actually took out a little profits with a 10% gain.
okay.
And then it came back down, did its retesting. I was staying above my stop loss, and then it took off very nicely. And on the 14th, this is where I was taking profits. I was going on the 14th. I had a move up about 25% from where I bought it at. So I took my profits there, took some profits off there.
Okay.
And then after earnings were over, I replenished my trade by buying again off of the 20-day moving average, or off the 50-day moving average, about $25. I filled the coffer up again at $25 with a stop loss that would have been slightly below that at $24.50. and then that led to the, I mean, I couldn't tell that was going to happen, right? I mean, I didn't know. I got in the way. And the big move that you saw there on the 23rd was where President Trump came out and basically said that they were going to ease the regulatory requirement for these small modular reactors. So now the question is, well, what now? We're getting a nice little flag pullback. Am I ready to buy again? Yes, I am, but I'm not ready to buy it yet.
Right.
So-
Wow. So, yeah, to your point, if you're able to figure out, well, where it's going to rain, all you have to do is stand outside and you'll get wet.
Exactly. So that's absolutely awesome, Mike. I mean, so okay, guys,
Yeah, well done.
I think we covered a lot of territory today.
Okay.
So what's your takeaway? What's your takeaway from today's session, Mike?
Well, I think that, well, we were both able to trade a couple of names very well. I think that if we tried to mix both, and I could see the temptation, right? Because there'll be some times when I'm sitting on my hands and you're making money, and maybe vice versa. So there is that temptation. I think that depending upon if you already have at least one thing like fully mastered, just like how you mentioned Mark Douglas spoke about mastering one thing first. If you really have one thing mastered and you want to do something else, okay, I think that it's all right to have that conversation. But if you haven't, if it's just like, well, this isn't working, let me try to something else, then I think that that's where people just end up having a yard filled with half dug holes, and that doesn't work out. I think that you've got to really master one thing first and then go on to the others.
Yeah, I agree with that wholeheartedly. And I want to approach it also from the avenue of majority of the people out there listening are busy. I mean, we're busy. You and I are busy with our business and all that kind of stuff.
Sure.
But you're busy. If you're working a career, if you're still, gainfully employed out there, and you're wanting to, teach yourself how to trade and all that kind of stuff, is that one of the temptations can be is, well, I have to know all of this stuff. And then I want to apply it here, there, and everywhere. But what that winds up doing is it by trying to apply too many things, you set yourself up, I think, for your eyes to lie to you. Because I remember when I would do some of my, checking the charts, checking the technicals on my watch list, and there was nothing to trade. And I'd go back over that list multiple times in an hour. I'd go back over until my eyes saw what I wanted to see, what my brain wanted it to see. And then I would put in just dumbass trades that would wind up going against me, costing me money. And now it's so much simpler to say, I trade two different processes. I trade basically the bounce off support, and I will take the break of the flag, if you will, on its way up, or break above the 8-day moving average, if you will. That's one of my other triggers. And by just focusing on those, it frees me up dramatically and gives me lots, time for the other things that I need to work on. So that's another great reason, folks, to pick a method, pick a setup and a trigger, and just live with that for a while. Live with it for 90 days, 6 months, a year. For some people live with that one setup for their whole trading career and doing well. My mentor, he used to trade bull flags, and that's all he traded. When he would, and you'd go, well, that's boring. Well, Yeah, that's the idea. We want our trading to be boring.
Mm.
unless you like, if you want excitement, if you want to lose money and all that kind of stuff, yeah, then don't listen. Okay.
Well, sure,
Excuse
people
excuse
say that bowling is boring or golf is boring. Well,
yeah.
guess what? If you roll the ball the same way and you keep on getting strikes, I don't know about you, but that's fun to me, right?
There you go. And so anyway, hey, so if you guys could drop a note. What was one of the takeaways you got from today's session? I want to thank Kevin for joining in and making a statement out there.
Mm,
And just remember, you don't need the best trigger. You just need to learn to trust your plan and trust yourself. Find a plan and develop a plan that has an edge, and then stick with your edge. Stick with your edge over and over and over again. So pick one strategy, commit to journaling it over a 30 days isn't quite enough. I think you should go out to 90 days and really track it, and also capture where's your mindset. If your mindset is saying, "Oh, I need, oh, it's not working. I got to go," because Mike mentioned right at the beginning, you get those 3 trades in a row that it goes against you, and I would say that 90% of the traders out there will just throw their system away and say, "Well, that one didn't work either," and they go on the new search for the holy grail of trading, and the holy
hmm.
grail of trading is inside of each and every one of us. So
There you
cool,
go.
Mike.
All
Any,
right,
any
cool.
last and finals for everybody?
Yeah, just keep on plugging away. Stick with one system. Have the system that you like. Trade that one system and stick with it until you've mastered it.
Okay. And if people want to find out more from you, Mike, what's your website?
Oh, sure. Marawealth.com. And we just put out a brand new 2-minute trading audit that people could download for free. It gives them a checklist to make sure that they have all the elements that they need for a well-tuned trading business plan. Not just a trading plan for your entries and your exits, but for your full business plan to help transform your trading from a hobby to something that's going to make you money consistently. So people could go over to marawealth.com and grab that for free.
Awesome. And if you're looking for anything about autopilot trading, you can go to autopilottraders.com. And some of the things that we've got coming off the shelf this month of June is we have a trader behavior diagnostic. That's going to basically, you take the diagnostic, it's going to rank you as one of 4 different types of traders, and also give you an action plan on what you need to do to start improving. And if you want to know more about that, drop a comment down in the comments on the YouTube channel. And remember,
Yeah, I'd like to know more about that.
yeah, it's really cool. We've developed it, and we've done the beta test on it, and the people who took the beta test said, "Oh my gosh!" And some of them hated to get the information, but it told them exactly where they were as a trader, and they go, "Yep, that's me." So anyway, hey guys, remember, we are live and we show up over on Spotify, we show up on X, we show up on Facebook, we show up on Instagram, we show up on YouTube. So please share. Well, one, you can leave a comment and leave a review, and also share this with a trader who is struggling with trading consistency. And I will just say aloha, God bless. Mike, always a pleasure, man.
Always a pleasure. Thanks so much, Dennis. Take care, everyone.